This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HTJ Tax. Good morning, good afternoon, good day, depending on what time zone you're in. So, thanks for sharing your time and thanks for joining us on Zoom or on Facebook, or on YouTube, or on LinkedIn. It's always good to see you guys. For those who joined us before, welcome back. And to those for whom this is the first time, welcome. Good to see you. And hopefully, I look forward to some interesting questions at the end, or comments as well. So historically, what we would have done is started off with like a presentation and then go into Q&A. But I found that the audience has become progressively sophisticated. So what I just tend to do right now is just dive straight into it. So for those who sent you questions in advance, thank you. So I'll go through them in the order in which they received. I'm sure we will have time at the end of those. And those who have logged on to the various platforms, feel free to type your questions in the boxes below. And I'll get to them in the order in which they are submitted. So without further ado, let's jump right in. So the first question, she's asked, if a non-American, so a non-US citizen, a non-green card holder, they were working in the US and they've given up their work permit, their work visa was, so she surrendered her work permit or work visa, and she's since left the US. She was awarded certain shares which vested after she left the United States. So the question is, are those taxable? Well, unfortunately, they will be taxable by the US. So typically speaking, because the exceptions to every rule, but typically taxes are recognized and reported and taxes paid when shares are vested, not when they are awarded to you. So when they actually vest, then you have the ability to liquidate them or do whatever you like with them, transfer them or whatever. So then they become taxable. So unfortunately, bear bad news, but if you have worked in the US and we see this a lot with certain technology companies, and you leave and you return to your home country, your home jurisdiction, the shares in the US company that were awarded to you while you were in US soil working for that employer, they will still be taxable by the US, even though you're no longer there. Typically, payroll teams are helpful in that they would make arrangements for you and help you with the withholding, so that you can still be, they can basically go through the admin for you of deducting whatever the relevant amount is and paying it to the Internal Revenue Service. But if that has not been done, then you should contact your preferred US tax professional and file the relevant return. So sorry, but yeah. Moving on, next question. Okay. This person is a social media influencer and YouTuber, and they're asking where you're going to be taxed. If you are, there are two scenarios, right? So there's a scenario in which you are a US person when you're not, right? And I'm assuming you're outside of the US. If you're outside of the US and you are a US person, then you're subject to taxes on your worldwide income no matter how long you remain outside of the US. You cannot sever tax residency with the US until you surrender your passport or your green card. So you still required to file US tax returns. And on that US tax return, you will declare the income that you make from the sponsorships or from the platforms, whatever the case may be, right? So it will be fully taxable by the US. And depending on where you are, and depending on whether you trigger tax residency wherever you are right now outside of the US, you will be required to pay taxes there. Of course, the question is, well, how is that jurisdiction going to figure it out? Well, the enforcement, that's another conversation, but legally, if you are tax resident in most jurisdictions and you're working, even when you're working online and you're tax resident, you need to check with a tax professional because more times than not, you will be subject to tax by that jurisdiction. Now, the second category, because I remember the first one is if you're a U.S. passport, so you're a citizen or green card holder. That's how it plays out. If you are not a U.S. citizen or a U.S. green card holder, i.e. you're not a U.S. tax resident, you're not subject to U.S. taxes, and you reside outside, then you just need to think about where you're tax resident, right? So wherever it is, again, I said more times than not, if you are a tax resident in a given jurisdiction and you're earning money there online or whatever, it would be subject to some sort of reporting, some sort of declaration. So you need to check with someone who is qualified tax-wise in the jurisdiction which you find yourself. Now, some platforms, for example, and more specifically, so most popularly YouTube, which is perhaps the biggest of the group, they have started making compliance easier in that they are looking at where you as a creator, a content creator, where's your content being consumed? And if it's being consumed in the United States, they can apportion the amount that is attributable to your viewers in the United States. And so they will withhold 30%. Now, if you're in a jurisdiction with a treaty with the US, like most of Europe, for example, most of Latin America, you may be able to file a return and you may get some of that money back because of the double tax treaty. What it sometimes does, it may make you subject to reduced withholding. So you need to speak to a tax professional about that. So I hope that answers your question as a content creator, as a social media influencer, as a YouTuber, where you're going to be taxed. The two scenarios being either you are US exposed and you reside outside, or you're not US exposed and you reside outside. If you're US exposed and you reside outside, you're going to declare it on your US tax returns as you normally do, and be mindful whether you do trigger tax residency in whichever jurisdiction you reside outside of the US. If so, it may need to be declared. In the second scenario, you are not a US person, then you only need to be considering the jurisdiction in which you reside. But also certain platforms, for example, YouTube, they will withhold the amount attributable to the US audience because then it's deemed to have been derived from the US. So I hope that helps. Okay, crypto. You know, there are quite a number of you that are into crypto, hence the questions that we get on it. If I am a crypto investor, where am I taxed? So I'm going to assume that, again, it's similar to the social media question asked previously. There are two categories. I'm assuming that because you're on this live stream or you've asked this question that you are US exposed. So you have a US passport, you have a green card, and you're international, right? So you're outside of the US. So where you're going to be taxed, you need to declare this on your tax return. So as I mentioned earlier, no matter how much time you spend outside of the US, if you are still in possession of that US passport, or you're still in possession of that green card, even if the green card has expired, or even if you lost it, unless you surrender it in the right way, that green card, and you get the I-407, or unless you surrender your US passport in the right way and you get a CLN, a certificate of loss of nationality, you will be subject to tax on your worldwide income, and that includes your crypto investments, even if it's on an exchange or if it's done outside of the US. It doesn't matter, you're taxing your worldwide income. Okay, hope that helps. Yeah, that's where you're taxed. No, okay, the next question is, how are crypto investors taxed? And again, I'm assuming that you are US exposed, given we're in a US tax live stream. So most accountants or tax professionals who work with crypto investors and crypto traders will tell you that from an investor perspective, we're guided by two IRS notices. One that was issued in 2014 and the other in 2019. The one in 2014, I think it's 2014-21, and that notice 20-1421, and then subsequently ruling 2019-24. So that's really where most people get their guidance. So the first one in 2014 basically told all of us, as I'm sure you were, that crypto is not a currency. It is to be looked at as property. So therefore, it'll be subject to the rules that are attributable to property, that have always been in existence, right? So if you buy and then sell within a year, it'll be short-term capital gains, which are basically ordinary tax rates, which top off at this point at 37%. If it is that you hold and then you dispose, or there's a liquidity event, or there's a taxable event more specifically, after a year of holding, then you're subject to taxes, then you're subject to long-term capital gains. Please remain muted. Thank you. Then you're subject to long-term capital gains. All right, so I'm just changing okay. Then you're subject to long-term capital gains. Just to be clear, the taxable events as disclosed in ruling 2019-24 would be when you convert crypto to fiat. That's obvious, and everybody knew that, right? But also when you trade one crypto for another, so crypto to crypto as a taxable event. If you spend crypto to purchase goods or services, you need to be talking to your tax professional, because that may be a taxable event as well. And when you earn crypto as income, because we have many clients that are paid in crypto, so it's all taxable under US tax rules. So hope that helps. I'm moving down to the next series of questions. And again, for those who've just joined, feel free to type in the box below what your questions may be, and we'll get to them in the order in which they are received. Thank you. So next question, what are acceptable ways of calculating capital gains in your crypto, right? So that's assuming that you're an investor, not a trader. So it's about buy and hold. Basically, everyone knew about FIFO. So like FIFO was seen first in, first out. So implicit in this is that, I know it's really hard sometimes, but you have to keep track of each trade. There's no way around it. You have to keep track of each trade. Otherwise, you're going to be in no end of hurt from a tax perspective when it comes to actually calculating and reporting. So everyone knew FIFO, first in, first out, and that was seen as like being very prudent, and that is completely acceptable. That's universal standard, FIFO. But since 2019, I think people have been comfortable with LIFO and HIFO as well. So LIFO is last in, first out, or HIFO, highest in, first out. So I think when you're speaking with your chosen tax professional, legally you can use either of those three options for calculating what your gains would be, but depending on your trading strategy, one may work for you better than the other, or market conditions or whatever. So again, speak to your tax professional and see what fits your specific situation. Next question. Again, lots of crypto questions. Thanks for asking. How can I be more tax efficient in my crypto activity? As I kind of hinted of in response to the previous question, the major, and I'm telling you stuff you guys already know, but just to point out the perfectly obvious, you need to keep track of every trade. So you're going to have a detailed spreadsheet or some sort of documentation that you can keep track. You've sold something. When did you purchase? What was the value in fiat at that point in time? So each trade, and that's not just crypto to fiat, but crypto to crypto, everything needs to be kept track of. And that includes drops and any sort of transaction, forks, drops, everything. Please keep track of them. Right. Hope that helps. Okay. Next question. Okay, this person is not an investor, but a crypto trader. Okay. So first of all, so they've identified themselves as a crypto trader. So just for those who may be unfamiliar with what he's talking about, there's when you look at the IRS, the revenue tax rules and the tax code, it's hard to really pick up what a trader is versus an investor. So, I mean, intuitively, you know that someone is a trader if this is not something that they're doing on the side in addition to their 9 to 5. This is their full-time gig. This is their full-time focus. That's what a trader is, and we know that intuitively. But in terms of the IRS rules, when you look at case law, because you have to rely on cases that have gone before the lower courts, what there are like 3 indices that will indicate a trader, someone who's a trader rather than an investor. And that's important because you may be able to treat your trading activity in a more tax. I mean, as a trader, you can still, if you want, you can still use the, you can treat your investments like the investor, right? So someone who holds on a shorter, for longer periods, and they're not as focused as you are as a trader. But there's certain tax advantages to the trader election that makes it attractive, and it's not suitable to everybody. But if you do trigger trader status, it can work in your favor from a tax perspective. This is why people are quite curious, including this person who asked this question, right? So what does it mean to be a crypto trader versus an investor? First of all, there's an intent to carry on a trade or business. So again, it's not something you do on weekends, it's not something you do after your 9 to 5. There's an intent to carry this out as your main trade or business. Secondly, the buying and selling is frequent and continuous. So frequent and continuous. So we have people that do just like a few trades a day, and we have high frequency traders that do hundreds of thousands of trades per day, algo traders. So it has to be frequent and continuous, and that's relative. I know it's not definitive, but that's what that gives you a sense as to what the rules are. Now, the third one is it must be profit seeking from short-term price swings rather than interest, dividends, and capital appreciation. So you're looking to benefit from, or you're basically looking to make income or derive a profit from short-term swings or arbitrage between different, in this case, in the case of crypto, different coins. So yeah, so I hope that helps. So once you trigger those 3, you are considered a trader, and you're able to basically, it gets taxed as a business, especially if you do it incorporated. We normally advise our traders to use a company. Some use companies in jurisdictions like Central America, like Panama is pretty popular, as well as some use Puerto Rico. So Puerto Rico is super popular, as you know, for crypto, but Cayman Islands, or, depending on whichever jurisdiction you are, because if you're outside of the US, you are somewhere, and you need to be conscious of their rules as well. And that may impact on your choice of jurisdiction for incorporation. But yep, so the point is that you normally do the trading through an entity rather than in your own name, but you can do it in your own name, but normally through an entity. And you may benefit from lower taxes, generally speaking, that accrue to the entity. But it really depends on the jurisdiction. It depends on whether there's a tax treaty in play, and it depends on how the money comes out. Whether you check the box and it could just flow through onto your 1040, or if you take it out as dividends or salary or whatever the case may be. So there are a number of strategies that you'll speak to your preferred tax advisor, and normally you'd run some scenarios to see what works best for you. Hope that helps. Okay, scrolling down. Yes, I'm seeing you writing questions. I'll get to you as soon as we work through these questions. Thanks to those who are still submitting questions. We're seeing you. Thank you. So if I get a second passport or residency somewhere else outside of the US and I'm an American citizen, can I stop paying US taxes? Now, that surprisingly common question, and unfortunately, sorry to be the bearer of bad news, but you should not. because even though you may have a second passport, and I know the Caribbean is super popular right now, or you have a second residency, whether you are in Barbados or you're in Panama or you're in Portugal or you're somewhere else in Bali, Indonesia, wherever you are, you're still subject to taxes in the United States. So you still must file and pay your taxes to Uncle Sam. As I mentioned before, the way around that is you must surrender your US passport. I know that's a huge step, but we help probably 3 or 4 clients every month give up their passports or green cards. So you need to surrender your US passport and get a CLN, a certificate of loss of nationality, to evidence this, and then you'll be free. Except for US source income will still be taxed, but your worldwide income would not be subject to US taxes. Alternatively, if you have a green card, you're a lawful permanent resident, you need to surrender that green card and get an I-47 to evidence that you have done this, and then you will sever US tax residency. And then unless and until that happens, you are under the, under the US tax laws as they apply today. Sorry. And another question, can you recommend a few jurisdictions where okay, well, yeah, assuming that you give up your US passport or green card, right? And then you become a non-American, where can you live full-time and run a business without paying individual or corporate taxes? Head and shoulders above the rest right now and super popular with us, so much so that we set up an office there, is the United Arab Emirates. And the most popular of these 7 Emirates is, of course, Dubai. One of the 7, but by getting residency, you set up your company, you get a residency in one, you're entitled to move freely and live in any of the 7. Kind of like states within the same federal republic, like the United States, right? So Dubai and the Emirates are super popular. Speak to your chosen professional about which Emirates you want to set up in and which free trade zone, because the way it works is that you pick not one of the 7 Emirates, but you pick one of the 45 or so free trade zones, and you form your offshore company there to do, to do your crypto, to do whatever it is you're doing online or internationally. And that company, you're able to sponsor your own work permit and that of your colleagues, your family, or whatever the case may be. So, but it's a bit tricky, right? Because you have like 45 free trade zones and the prices vary dramatically. I mean, it is a huge difference between the cheapest one and the most expensive one. And you don't just automatically jump and pick the cheapest one. I know a lot of people who've done it and then they feel some pain afterwards because there's certain implications as to where you form your company, which free trade zone you choose to use. So speak to an advisor as always before you jump in the deep end. So thank you. I'll go on to some more questions now. Scrolling. Okay, I'm gonna hide. Right, so I can see better. I am a US citizen and will soon begin working for a non-US company outside of the US. Okay, so US citizen working outside the US for just a non-American company. I do not live in the US, right? Got it. I haven't worked since before I was married. I am married to a non-US citizen. Okay, so gotcha. Does it make sense to just file as a single person? Okay, so legally, that would probably not be the correct way because that would be misrepresenting your filing status. So basically, in terms of your filing status, it would be single, married filing separately, married filing jointly, head of household, and widow, right? So let's stick with the first 4. If it is you are legally not single, you should not really be filing as single. You can elect to file jointly with your non-US spouse, which some people do for strategic reasons. We invoke section 6013G for that, because it may be to your benefit as a couple, even though that person is not American, to bring them into the tax net. It is a radical choice that you should do in concert with a tax advisor, but it sometimes works. That's a card that you cannot ignore. It can be played, but ordinarily speaking, you will file married filings separately. However, if you do have a child, whether biologically or by adoption, and if that child is a US person with a social, then you can also file head of household. And of course, head of household is, you get the same tax bands as married filing jointly. So from a tax efficiency perspective, you should be looking at head of household if you have dependent kids. Otherwise, it's married filing separately. So blah, blah, blah. I have all my accounts separate from my husband. Well, we also have 2 kids, which are US citizens. So I think, again, you need to consult your preferred US tax advisor, but typically head of household is way more tax efficient than married filing separately, and filing as separate is probably not the legal way. So hope that helps. Scrolling down to the next question. Hi, I triggered substantial presence in 2020 to 2021. So last year and this year, due to the pandemic, yeah, a lot of people did. We had we had quite a few clients who accidentally triggered substantial presence in the US because of the health situation, right? But this person is not American, and he or she's asking, do I need to file taxes for the next calendar year? I don't have income in the US. I was stuck there due to a lack of flights. Now this happened all over the world. Now there have been, depending on jurisdiction you were in, there's some allowances or whatever. So I think you should check with your tax advisor, but generally speaking, if you did trigger substantial presence last year, so 2020 and 2021, you should have filed a return for 2020 on your worldwide income. And if you also triggered substantial presence for 2021, then yes, in 2022, you should be filing a US tax return for 2021. So yeah, probably not the answer you wanted to hear, but that's the way US taxes work, unfortunately. But it may be worth speaking with an advisor to see, because the IRS did issue some notices, I believe, that may allow some slight wiggle room. So please check with that. And don't forget, if you're in one of the states that does have a state income tax, a state tax return may be due as well. So keep that in mind. Next question. Do you have a recommended tax professional or tax partner in the Philippines? Yes, we do. We do have an affiliate office in Ortigas in Metro Manila. So please feel free to contact us directly. Just email help@htj.tax. That's help@htj.tax. And we will look after you. Make sure your requirements in the US and, if needed, the Filipino perspective are done properly. Okay, next question. So Joe's asking, I'm a dual citizen, US and another country with a tax treaty. And thanks for indicating that, Joe, that's really important. And I've been living outside of the US for many years. My income comes from a non-US company. Do I still need to file US taxes? Joe, unfortunately, yes, you do. You will be required to file and pay taxes, obviously in the country in which you are resident, but also in the United States because you are a US citizen. And I think when you mentioned in your question that there's a tax treaty in play, I can tell that you've been doing some reading, you've been checking this out. So you may want to speak with a firm that understands the international tax rules, because sometimes when you just speak to a firm that's domestic to the US, domestic taxes as opposed to international. So you want to speak to a firm that deals with international clients and who is aware of how to navigate the tax treaty. So that's not to just ensure that you are not taxed twice on the same income, because you should get automatically credits for taxes paid outside of the US. You get taxes which should, to some extent reduce your US taxes due. But also there are other articles in the treaty, and depending on the nature of your income, it may even bring the taxes down further. So again, speak with an international tax team who's familiar with international tax issues, including leveraging that tax treaty. Good luck, Joe. Next question. Is it true that if I'm living and working outside of the US, I make less than 100 grand, I'm not taxed? I'm a US citizen. Sarah, that's a good question. It really depends. Now, what I think that's a popular misconception. That's a popular, not a misconception, but a misunderstanding. So I'll take you back to the source. It comes from section 911 of the US tax code. And that speaks about something called the foreign earned income exclusion. And my emphasis was deliberate on earned, because if it is that if you're making 100 grand or less, but that is earned income, and you may be able to enjoy the foreign earned income exclusion, which, to be honest, is the best tax break available to US exposed persons, US citizens and green card holders who reside and work outside of the US. But it must be earned income. So it does not include interest, it doesn't include dividends, it doesn't include basically unearned income. So yeah, so it's very, very specific. So to be honest, it really, someone needs to sit with you and understand what is the nature of your income. Is the 100 grand that you're earning, is that like interest, or is that dividends, or is that earned income? So you performed a service, or you're selling a product, you engage in some sort of business activity for which you're getting that in return. So if it is earned income, then you may be able to trigger the foreign income exclusion. And as the name suggests, you would exclude that income from US taxes. Now, there are two ways of qualifying for that foreign earned income exclusion, earned income. So the first is the one that everyone gets. So it's quantitative and objective. So that is the physical presence test. So once you stay out of the US and you're not in US airspace for more than 30 days in any calendar year, typically you will qualify for the foreign earned income exclusion under the physical presence test. The other one is subjective and qualitative, and that's the bona fide residence test. So that's more or less like a test of intent, like where's your center of life, where's your heart? And if your true home is in another jurisdiction, so your family's there, you own or you rent property there, you have a job there, you pay bills there, you belong to social clubs, whatever the case may be, that is genuinely where your life is right now, then you may be able to enjoy that even if you cross 30 days in the US. So for example, you're trapped because of a lack of flights or whatever, you still may be able to enjoy it because of that bona fide residence test. But however you qualify as either physical presence or bona fide residence, once you do, your first, well, it moves higher with inflation. So I think for last year, it was like 107,600 or something like that. So it goes up each year with inflation, but that income will be sheltered from US taxes. So yes, speak to your tax advisor, but you still need to report it. So even though no taxes are payable, you still need to file a US tax return. The filing threshold for return is pretty low. I think for married filing separately, $5. So if you made more than $5 outside of the US, again, no taxes may be due, but you may still have to file a return. Hope that helps. Okay, next. Okay, someone's asking, yeah, so in order to find out, you need to email help@htj.tax. That's help@htj.tax. Okay. Any other questions? We've gone through all of those that I have received and I'm seeing. What I'm going to do is I'm just going to check on some of the other platforms. I've been reading so far off of Zoom, but I'm going to look at what people are asking. Okay. So for now, those who are on Facebook. So if you derive income from US clients, but are not tax resident in the US, you're not a US citizen, you're not a green card holder, but you derive income from US clients, you live outside the US, can you qualify for the foreign earned income exclusion? Kim, that's a good question. So if you are not resident in the US and you have so you're not a US tax resident, so if it is that you're not a tax resident, so you don't have a green card, you don't have a passport, you don't trigger substantial presence, then you're not a US resident, you're not subject to taxes. So if it is that you derive income from US clients, assuming that it's for services rendered. Oh, I'm sorry. So sorry, Kim, you corrected me. Okay. So you're not resident in the US, but you are a US citizen. Okay, fine. So you're a US citizen, you're outside, and your clients are in the US. Yes, you're still subject to, you can still enjoy the foreign earned income exclusion if it is you qualify to section 911 by virtue of the physical presence test, which we described before, or the bona fide residence test. So yes, you can use form 2555 and make sure that you exclude the first 107,000. Plus, you get a housing deduction as well. So in some jurisdictions, we see that go up to like $150,000. So the first 150K of your income can be shielded from U.S. taxes thanks to a combination of the foreign earned income exclusion plus the housing deduction, which is, I mean, this is the best deal for US persons who work outside of the US. So I hope that helps, Kim. Another question. As a Canadian investor investing in US real estate, what taxes do I have to consider? So great question, Loan. Well, I'm assuming you're resident in Canada, so obviously you have Canadian taxes to think about, but obviously I'm assuming that you'll be familiar with that. Otherwise, we have an affiliate office in Toronto that we can introduce you to, and we work hand in glove with them to deal with clients that are exposed to both Canada and US taxes. But from a US real estate perspective, assuming that you're just a real estate investor, then you'll be subject to state taxes if you're in one of the states in which it's going to be taxed. So you'll be subject to taxes at the state level, and you'll be subject to taxes at the federal level. So yeah, and you'll also probably have local taxes. They're like local property taxes as well, which depending on which jurisdiction you'll be in, it will be a calculation based on property values. So you have local taxes or property taxes. Then you have state taxes if you're in one of the states that does have a state income tax. And then you have the federal taxes. So you'll be looking at all three of those taxes. The best advice I can give you is do speak with someone who's US qualified and is familiar with international taxes. But also the default is that the rental income is treated as what we call FDAP income, which is fixed, determinable, annual, and periodic. So it'll be subject to a certain percentage withholding, which will be 30% plus reduced by the US-Canada treaty. But you can get around, it's probably 9 times out of 10, at least in our experience, it's more tax efficient if you elect to treat the rental property as a trade or business. So you make the requisite election for it to be treated as ECI income, effectively connected with a trade or business. Speak to your tax advisor, because that's an easy way of getting real savings. In addition to which, you can have cost allocation studies, and with a view to really leveraging depreciation to further bring down the taxable income. So you can do it on your own, but I strongly advise that you speak with a tax team that can help you do real estate investments. Okay. Okay, then now she's asking, does it matter if we're in an LLC or an individual? That's a good question. From a US tax perspective, an LLC does not confer any tax benefit. You're not going to save money, despite what people say on YouTube. People without a license on the line, of course. You're not going to save any money from an LLC. An LLC is probably more for asset protection. So as you know, the US is a very litigious society. So, someone slips and falls, or worse yet, finds mold in your property, mold is gold. So if something unfortunate happens, they have the right to come after you and whatever other assets you may hold, right? So to limit liability, we use what is called a limited liability company. As the name implies, it's about protection as well, protecting you. So that is the real benefit, asset protection from a tax perspective. The default tax treatment for an LLC is that it is treated as a pass-through. So if you're investing on your own through an LLC, it's, it just flows on, well, it's, I won't say what schedule it's on, but you're going to be taxed in the same way as if there were no LLC. So no, there's no benefit to it. It's purely about asset protection, but it is good principle. Don't hold investments like that in your own name. Seek the protection of a limited liability company. Get advice. All right. Any more questions? I'm just going to look on some of the other platforms, see what else people are asking. Okay, great. All right, nothing there. Okay, great stuff. Again, any last questions? Otherwise, we can call it an early night, early day, early morning, depending which time zone you're in. Okay, great. So I guess that's it. Thank you for your time. And thank you for your attention. We do these live streams probably every week. So, yeah, sorry, there's a question. Jewel, your hand is raised. Please ask. Okay, I guess it's a false alarm. All right.
Yeah, maybe he's clapping.
Yeah. All right. Okay. Gotcha. All right. Thanks, Jules. So, right. So we do these live streams every week, different topics and with different speakers as well, together with myself. So please feel free to have a look at htj.tax and join us anytime the topic is of interest to you. If you want to follow up with us directly on any of the opportunities or the issues raised, please feel to email help@htj.tax. That is help@htj.tax. This has been recorded and it will be available on Facebook, LinkedIn, YouTube, and probably 20 other podcast platforms, iTunes, SoundCloud, Google Play, wherever it is you get your favorite podcast. This recording will be available there. So you can listen to it again, or you can recommend it to any of your colleagues or friends if you think it is appropriate to their situation. But nothing we said here should be construed as advice. This was just a general conversation about general principles. If you want advice that's specific to your situation, there's no shortcut to speaking to a qualified professional. Again, thanks for your time, thanks for your attention, and we'll see you next time. Bye-bye.
Here are 4 ways we can help you. Number 1. Sign up for free webinars on US expat taxes and international entrepreneur taxes at www.htj.tax. Number 2. Stream premium educational videos at www.htj.tax. Number 3. Contact us for tax optimization consult over Zoom. Number 4. High net worth. Weekend quote for doing your US international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.